Welcome to Trading the Trend. My name is James Boyd. Today's date, September 25th. My dad's 75th birthday. And he actually moved out here to Utah. Happy birthday to him, Dad, if you're watching. So, happy birthday. All right. Just real quick as we get started here today, I'd like to welcome all of you actually here today. We got Rachel in the chat. We got Scott with us. We got High Speed with us. Gary, Dom, Will, Dean, Willis, and many others. Just real quick as we get started, I want to give you a quick reminder. This is being recorded. You could actually, I'm going to share with you the playlist and right now where you can actually find this. And let me just bring that up right there. So if you said, where can I actually find the playlist? So with each one of our classes we do, okay, this is the playlist. You can bookmark it and you can see other previous sessions, okay? So I don't want you to think that if you're watching this, like where do I go to find it? Right there, just bookmark it. Now, remember, you can follow Rachel or myself on X. We do post educational content there daily. And what you're now going to notice is if I go back to that, quick heads up, there's my handle, @JamesBoydCS. Probably over the last 5 years or so, I've posted almost 22,000 times. So quite active in terms of posting educational content. So check that out. Just real quick also, as we get started here, remember when we talk about stocks and options, remember that options carry a high level of risk and are not suitable for all investors. Also remember when we talk about the information is provided for general informational purposes only. Please do not consider it an individualized recommendation. It should not be taken as such. It's an example, okay? And also what we're going to do is we're going to talk about using example trades, whether stocks or options, in a paper money software application for educational purposes. When we talk about investing, with reward potentially comes the risk. We want to know what that risk is and whether it's like a defined max loss strategy or is there risk all the way down to zero on a stock and so forth. So also remember when we talk about short options, those can be assigned. You either deliver the shares at the strike price because you have them already, or you buy the shares at the strike price because you're short. And so understand that we could be assigned at any time up to expiration regardless of the in-the-money amount. That's called American style options, and that's the ones that we show examples of in this class. Also want to give you a quick heads up that coming, if you go to schwab.com/events, 3 different events we got. We got the Chicago Market Drive, 1-day event. We also got Orlando, the 10th and the 11th, a 2-day event, and also the Anaheim Market Drive. Now, you're going to actually notice that if you're a Schwab client, you can actually attend these for free, so join us. And also, if you went to schwab.com/events, you'll see other events coming into 2026. My gosh, I can't believe I just said that. Okay, so check those out. So these are also where you can meet other investors like yourself there, okay? And also, you could just be traveling in the area, okay? Or maybe you live in the area and so forth. Join us. Now, just real quick, as we talk about examples here today, we'll talk about kind of indexes, any commodities that are standing out in terms of prices. We'll talk about kind of sectors, mixed picture there. And we're going to also kind of talk about some of the warning signs that we're seeing on some charts as they're starting, some of them, to pull back. Now, I'll be honest, this is kind of like my specialty. I kind of like it when markets pull back, okay? And sometimes people are like, I don't like it when markets pull back. Well, it kind of depends upon your skill set, okay? So today we're going to talk about some bullish examples. Yes, we're going to talk also about protection in some cases, okay? And then like we did yesterday, we'll talk about some exiting and stop adjustment because that's appropriate, okay? Now remember, investing or trading is not just buying stuff and buying stuff and buying stuff. It's really buying and selling, okay? And the goal is to ride that trend and ride the trend until there's signs of selling pressure reaching to a point where the investor decides they're going ahead of time to sell. Okay, or try to have that order filled. Now, what I want to do just real quick is if I pull up, let's say, the indexes briefly, if I look at this and kind of said, okay, now by the way, if you were to ask me, and I've done this for a couple days, when do kind of people tend to give all their money back in terms of the unrealized gains of recent entries? It's when the VIX is low and they all of a sudden start to become, let's say, undisciplined, and they're not really watching the stock charts anymore, okay? And then they start pulling back. Fast forward a couple days, stocks pull back more, the indexes pull back more. And now all of a sudden they look and say, I haven't really been paying attention for the last week, okay? And now I feel like I missed the exit. Why do we do that? Okay? No one here is so busy you can't look at a couple charts. I don't believe it, okay? Every time I get on a plane, everyone's playing that little stupid Juul game, okay? And everyone tells me how busy they are. Nobody's that busy, okay? There, I said it. Now, here's the deal. If we take a look at this, what is different than what we've seen before is when we look at the SPX, the NDX, the RUT, the Dow Jones, does anybody notice anything a little different? Well, what we notice different together is we actually see trend 5, trend 4, trend 5, trend 5. Now, again, when you get that trend 5, what's that telling us? Now, remember, when you get trend 1, that's actually prices below both moving averages. You get trend 2, that's actually the price snapping back up, breaking diagonal. Trend 3, prices above both moving averages. Trend 4, price is kind of chopping up near resistance. And really trend 5, you actually get the price pulling back. 2 and 5 are just the opposites. 5 is bullish breakouts, okay? Bull, B-O, okay? And 5 is a bearish breakdown. Okay, bearish breakdown, BD, breakdown. All right, here it is. So if we actually said, well, which one's still at resistance? Well, it's the NASDAQ. But when you look at the SPX RUT and actually the Dow Jones itself, well, now you're getting 5. And so it's starting to slip. If we get further deterioration on the price, we go all the way down to 1. Okay, now, when we start to get into those type of conditions, obviously, we would be thinking about, are there exits? And you should know ahead of time, what are your exits? If you can't explain your exits in like 2 minutes, it's too complicated, okay? So second, you need to actually know what is your stop methodology, okay? And again, if you cannot explain it in 2 minutes, the likelihood of that execution that you're gonna do that is low. And the third thing is, do you actually have any type of strategies that are actually, that you're gonna use to defend defense, strategy, defense. Now, defense could be like, hey, I'm going to buy a put on the index or go short the index, okay? Or you could actually say, I'm going to do a cover call. I'm going to buy a put on a stock that I own for protection. I'm going to color the position. All of the above. Could you do a short call spread? You could, not very bearish. Could you do a long put vertical? You could, but not very bearish. Of the ones that I mentioned that are kind of have a little bit more bearish defense is really going to be buying the puts, but probably for the most part, collaring the position, okay? Now, if you ask most people, what is a collar? They're going to be thinking that's your like shirt, okay? We ain't talking about the shirt. We're talking about protecting the shirt of the capital in the portfolio. Now, here's the deal. Knowing about the strategy and actually doing it and having a history of doing it, two totally different things. And you'll find out when you start poking away with questions who really knows what they're talking about and who really doesn't. Okay, so we're going to talk about 1, 2, 3 here today: exit, stop methodology, strategy, defense, and so forth. If you feel like that's been a weak area, well, welcome to the class. We're going to brush up on it. So when we take a look at this, we also go back just real quick to the sectors, and we'll pull up the charts in just a moment. We pull up the sectors. The only sector that I saw that was actually, well, there's 2 of them, but if we kind of said what is up a little bit, it's still energy. We'll show the charts in a sec, and it's Dow Jones Transports. Now, you're going to see that many of these, when you look at healthcare, when you look at, let's say, discretionaries, when you actually look at industrials, when you take a look at, let's say, financials, you take a look at consumers, communication services, you're going to see the trend 5s, okay? So you're seeing that common theme as of right now, kind of seeing a little pullback. So when you think of trend 5, think of the bearish momentum is building, meaning that price is falling. Now let's fast forward a couple of these charts and kind of take a look at what we're going to kind of manage here. So when we actually take a look at the SPX, you look at this chart and it's just below the moving averages. So nothing different than what we already kind of depicted, but it's just below. Okay, now no one's saying that this is intermediate bearish. Nobody's saying it's long-term bearish, but sometimes these trends in the short term, they break down, and that's what's happening. So we actually go fast forward and say, show me that NASDAQ just real quick. There it is. Now, is it possible that this could be the flag? Well, sure. Okay. That's what I kind of mean. You can have short-term breakdowns, but they would just be setting up bull flags. So nobody's saying here, bear market. Nobody's saying that. Okay. But what we are seeing is if you do short-term trading, there could be some exits or reasons to consider option protection. Now, when I pull up, let's say, and we pull up the SPX, we pull up the NDX, silver today did make another brand, help me say it, brand new high. Okay, thank you very much. And so you could pull up that chart. But the one I kind of just pull up just for just a second is you look at energy, that one kind of went poke or pokey to the upside, okay? And if you take a look at, let's say, the Dow Jones transports, which looks different than probably the transports that, and again, this is why I haven't historically looked at this. Look at the other chart that kind of describes the transports. This one doesn't really have the weighting that the other one does, but keep an eye on transports, okay? But probably of those, we really see that it's energy that's kind of leading the way a little bit, okay? Now, what I want to do just real quick is let's kind of show a couple things that I want to pull up. So first off, let's imagine the investor said, you know, James, I got a stock, Bank of America, and I'm actually starting to see on my chart that it is trend 4, okay? So in other words, the investor has the shares already. They have them. And now they're saying, well, is there reasons to maybe consider protection? Okay, well, trend 4 would be one of them, okay? Trend 4 is maybe when the price is up near the area of resistance and it might not go any further. Now, the other thing that kind of might be kind of a giveaway that this might be an entry for protection outside what I just said is that the shorter term moving average goes red. Ding, 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 dong. It's now the short term moving average is red. It's been red for 2 days. So this is kind of now, a lot of investors look for that. They either see trend 4 or 5, and then they also see the short term moving average go red. If that happens, you're starting to actually flag back. Now, I'm going to pull up the chart just real quick. We pull up that chart, type in BAC. Let's kind of look and see, confirm what we're seeing on that monitor page. Here it is. Now, is this giving us any indication that it might pull back a little bit? Well, we're below the shorter term moving average. We can see that. Monitor tab was right. We're now below the 20-period moving average, and actually we're getting to step 2, which is the crossover, okay? Now, here's the thing. Never, when we talk about, let's say, selling in the short term, the investor is probably thinking, look, I might sell some of my trades in the short term, but when this happens on some positions, they might say, I'm just going to use options as a way to protect. Well, let's go back to the caller for just a second. A caller is just really, and I'm going to baby step this and we can hit this quick, but if we have 100 shares of stock and those shares are purchased at 51.41, the investor might say, look, I think the stock might pull back, meaning it falls from maybe where it is now and goes down. Well, maybe the investor says, I'm going to try to sell a call. Well, wait, how do you sell a call if you already have the shares? We're going to go to the trade tab. We're right there. We got BAC. Okay, so that's not too bad. Now, if you're going to agree, let's think about this if I was going to decide to sell my house, okay? Let's say I put out front $1.25 million. And I said, price good for the next 3 years. That's not great, because what if the area in Salt Lake explodes, right? But if I said, hey, $1.25 million for the next 30 days, kind of like that, right? So the seller likes that shorter duration because they don't cap themselves out indefinitely, for that, 30 days versus three months. Excuse me, 3 years. Now, if I took a look at this, I'm going to go look at the October expiration first. And so when people kind of really look at, let's say, the premium, they're usually saying, look, I want a certain premium relative to what I bought the stock for. So if they said, hey, I'm going to go look at the chart and say, where do I think the stock can get above? And they could try to sell that strike, or they could actually come down to, let's say, just look at Delta only and say, look, I'm going to pick the strike that has a delta between 30 and 40, which is out of the money, which is above the current stock price right now. Now, if we look at that, it's going to give us, in this case, 83 cents if we sold the bid. Now, if we took, this is important here, okay? If we got 83 cents, that's the option premium, okay? And let's say the investor bought the shares for 51.41. What is that? Well, that's the stock price. That's where I should say the trade price, okay? The trade price. All they're trying to really do is say, look, if I did that, what percent option premium, so 83 cents, divided by 51.41, and it's 1.6%. Now, I don't know what the number is for you, but many investors, they want to at least get 1.5%, okay? And what is the 1.5%? It's the option premium divided by the traded price. If it's greater than 1.5%, they might say, hey, I might consider that. If it was like a half of 1%, they're saying there's not much upside gain from the premium to commit myself to sell for nothing, like very little. Now, that's going to be affected by how much time there is remaining to expiration and also the volatility. Now, here's the deal. On the covered call itself, if we said, okay, how do you sell the call? Just click on the bid. Okay, don't overthink it. Just click on that bid. And if we click on that bid right there, that option, it's going to bring up a sell the call. So when you sell the call, what do you want the stock to really kind of do, if you will? Well, you place a cap on the stock in the short term for the next 22 days. Yeah, you kind of want time to go by. You want volatility to contract, okay? The con about this is you cap the upside, but you think because of your technical analysis, the stock is more likely to go flat and or pull back a little bit. If we go confirm and send, note the commission, 65 cents. You get a net credit there for every 100 shares, 82.35. If we actually send that order right there, you're now going to see this turns into a covered call. So here's what you got to understand. How many shares do you have where you at least have 100 shares of stock? Those 100 shares of stock could be used to create covered call income. Covered calls are typically done when the VIX is low and starting to increase. If that happens, you're in trend 4, you're shifting into trend 5. The biggest actually thing is you're selling the call when you think the likelihood of consolidation and or pullback is high. If the stock actually goes to that 53.5 at expiration, someone could get those shares at expiration, but also prior to expiration. Now, if tomorrow all of a sudden these shares are gone, that means the investor makes from where the stock is now up to 53.5, and they get all of the premium. Okay? Now, that would be awesome because that means the investor did not have to wait 22 days to get it. So that could happen. Not completely probable, okay, but it could happen. Okay, now any questions? Any questions? Well, Wiley says, listen to one of JB's classes at 2 times the speed, 2x speed. So here's the truth. You know, on YouTube, they used to have like 1, 1.25, 1.5, 1.3 quarter, and 2. Well, now they got 3. 3's a little quick, but that's true. Most of the stuff I listen to on YouTube, it's probably a 2.5. All right, okay. Now, let's say the investor say, well, James, this is all fine and dandy, but this is an income strategy. I'm more concerned about the downside. And again, if they wanted to just come over here and let's say buy the put, all they'd have to really do is come over here and say, okay, which strike has a delta between, example given, delta 30, 40, they could just come over here and buy the put. I'm not going to do that right now because I want to kind of focus on the cover call for just a moment, okay? Think about this. Do you have any shares that are in the paid money portfolio where you're starting to see the stock in trend 4 and you're starting to see the short-term moving average go red in like the last 2 days? Do you have any examples? If you do in the paper money account, I'd like you to practice selling calls, okay? Practice that. You're going from a stock position to a covered call. Now, I also want to go back and look at just real quick, let's say let's kind of take a look at one that's been in play for a little bit, okay? And then we're going to look at some new positions. So example given, let's say we kind of fast forward in time. Now, by the way, when you have a covered call, the investor has the shares. So if the investor has the shares, it wouldn't take a rocket scientist to understand that if they own the shares, of course they want the stock to go up. The shares are purchased at 76.66, and the stock is up to 78.90, and the stock is up $224 a share or $224. Now, if you take a look at this, we sold the call, the 80 call, and if the stock price is getting closer and closer to the 80 call, what happens to the option premium? Well, the stock actually gets closer and closer to the option strike, the premium should be increasing. So that actually means we sold it for 157, but if we want to get out now, it's going to cost more to buy it back. So in this case, we're like, wait, I feel like a loser because I'm down $62 on the option. That's separate from the stock. And if you look at the stock, where's the gains? The gains are in the left hand. You're right as you're looking at me. And what you're now going to notice, we've got $217 in one hand, and we got a negative 60 in the other hand. And if we combine those two together, we have $155. Now, in the covered call, what do you really want this to do? The way you make the most money in the shorter term, you have the stock get above the strike price. That's what you want to have happen, okay? Now, if you took a look at this and said, well, what percent of the maximum gain do we have? Should we get out of the position? What should I do? What should I do? What should I do? Well, let's just draw it up. So from 76.66, that's where the stock was entered, and the cap is at 80. So this just becomes a basic math game now, 334. That's the upside. Now, there's no calculus here, Pythagorean theorem, there's none of that stuff, okay? What you're now going to notice is just basic math. And what was the option premium? You wouldn't agree to sell those shares for nothing. Well, you took in $1.57. And we're going to add those two together. Feel free to use a calculator. And if we did this, we got 1, you got 9, you got 4. So the most that we could make in this case, check my math please, is $491. That's the most we could make. Well, where are we at now? 152 of the 491. What would you do? If you have 152 bucks of the 491, what percent is that? Answer, 31%. We wouldn't dream of touching this until we probably got to 50, 65, 80, okay? 50%, we're starting to get there, we're close. But this right here, it's still there. Now, hold on for just a sec. Could you trade this like a regular stock position? You could, okay? If we actually look at Corning and actually said, what's the trend of Corning? Well, the trend of Corning is in 4. If all of a sudden Corning started going down, could the investor just exit the position and sell, and try to take that gain? They could. When that stock is pulling back in the shorter term, it doesn't mean that the trend is over. You're going to notice that we have had pockets where we pulled back right here, and we had pockets where we pulled back right here, and we had pockets where we pulled back right here. And they didn't last very long. Now, let me just make sure you're crystal clear on what I'm also saying. So what sometimes people do, and I know you're thinking this now, because great minds think alike, can't fake me out, okay? I know you're thinking this. Hey, James, could I maybe just do like sell call, like when the moving average turns red? And if I wanted to try to not have a capped upside indefinitely, could I maybe try to BC buy call back when that moving average turns green? Or could I actually buy that call back when there's confirmation on that 20-period moving average, whether it's here or here? Oh, of course. Of course. Okay? Don't make me like just melt down here. Of course. Like, where has that investor been? Okay? So really, the investors actually applying collars or puts, or they're actually using covered calls when the shorter term moving average goes red, and trying to maybe even take them off if they wanted to trade and say, look, I'm going to try to put on the protection when it goes red, buy it back when either of the moving averages go green, and then try to play the trend. But what they're really trying to do is if they bought the stock for, let's say, 56 bucks, and they actually collected $1 here, theoretically, their average price really becomes 55. And then if they did it again over to the right, and they maybe got, let's say, $2 over here, theoretically, their average price becomes 53. So when these stocks flag back in the short term, what they're trying to do is they're trying to reduce their average price and what they own the stock for, which kind of increases if they pay dividends, okay? Kind of increases that yield because they have a lower average price. Lots of other things you could talk about there. But that's really what investors are doing. They're trying to pick a good company and actually use option premiums to drive down that average price of what they own the stock for. Any questions with that? Now, Journey actually says, my gosh, Journey, I'm so glad you asked this question. Now, let's go back to this just real quick. There was a question, there was a comment. Let's go to our other trade. So yesterday we had a stock, ExxonMobil, that was right near an area of resistance, okay? Right near the area of resistance. Now, yesterday I was teaching the trading growth and value. It's a stock class. And we said, hey, let's kind of practice looking for stocks that are up near resistance and sell, 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 okay? Now, why did I do that? Well, because people said, like, hey, I need to practice like identifying stocks up near resistance and how do I sell and things like that. Now, if we were in today's class where we could talk about stocks and options, this would have been a classic example of if the investor said, look, I'm bullish ExxonMobil. The stock is up near resistance and maybe I just wanted to sell a covered call, okay? Now, let's go now one day to the right. And now, so let's say the investor yesterday put on a covered call on Exxon, and then today, all of a sudden, the stock kind of looks like it's trying to push up through the area of resistance. Okay, now the comment actually from Journey is, can I sell to get put the shares? Well, the biggest actually thing is, so the language what you're saying is, can you sell the call? Can you sell the put? Tell me what you want to sell. Like, are you talking about selling a covered call? Are you talking about selling the put? Let's just make sure we're on the same page. If the investor said, James, I would like to maybe sell a put to try to get long the shares of the stock. So what do I mean by long the shares of the stock? That the investor buys the shares of the stock, okay? Now, what I'm going to do is if the investor said, look, I want to try to get long those shares of stock, the investor is going to go to the trade tab, type in XOM, and what they're now going to do in this case is let's show this example where the investor might decide, hey, I'm going to actually try to sell like a strike close to where the current stock price is right now. So here's where the stock is at 115.87. And if the investor sells the 115, think of the kind of this little scale, right? If the investor sells a put that actually has a higher strike price, they're really saying, I kind of want the shares. Why? Because they think it's going to go up, okay? Or at least hold value. If the investor says, you know what, James, I actually was kind of doing it because I wanted a lower delta, they're kind of trading more for, let's say, the probability, the potential income, and a lesser chance of owning the shares of the stock. So you got to decide ahead of time. Do you want those shares of stock? Are you the investor out that says, I'd like to try to get long those shares of stock? Then they might go the at the money strike. Maybe one strike out of the money on top of that. Maybe like something like a high 30 delta. If the investor says, look, I actually want to kind of do more probability, they might be selling something like 30, lower than 30, okay? Now let's take this kind of route that we said, hey, I want to sell the 115. And by selling the 115, we know immediately what's the strategy. Now, you could say, well, wonder if the investors sold that and they didn't know what they were doing. But that's not us. Okay, they could. Okay, and there are some of those that, true, they maybe don't realize what they're actually doing. but not us. Now what you're going to see is we're going to sell the 115, and let's say we get in between the bid and ask 187. If we did that, what you're now going to see, now remember, this has 22 days to expiration. Same thing I said before. If you're selling something closer to expiration, you want more of the time to be on your side. Faster time decay, okay? And you don't want that commitment longer term. Okay? Yeah, so Journey actually says, yes, put to get long the stock. Now, so let's kind of practice this real quick, okay? Now, by the way, I love to have this back and forth conversation. A lot of times when people are teaching, they're like, well, I have to kind of stick to my little schedule. That way my mind, I don't need any of that, okay? If I teach a class, I don't need a sheet of paper. I can just teach a class right on the fly. Why? Because if you're investing, this is what happens, okay? Now, if we look at this, we're going to sell the put. And now just remember, just real quick, so we don't have a max loss of 11,000 because that's the stock going all the way to zero. Just briefly, I'm going to go down and just buy a put way out of the money, okay? Sell, and I'm going to go down and even buy something even lower than what we normally look at, if we can. And I'm going to go look for something like maybe like the 104. Now, it's going to eat it a little bit into the premium, but we're going to make it here in this case where the risk is not all the way down to zero and the buying power or slash max loss is not $11,000. I think many investors might consider that. It's for up to you to decide. Note the extra commission. We're going to go ahead and actually send the order, and we're doing the 115, the 104. Now, here's a quick question. Okay, yes, I need a theme song here. Name a Dow stock here. Name two Dow stocks that actually had a pretty strong move here today. Any Dow stock? Now, the theme that we're going to talk about here is there anything that we could practice selling a put on? Now, as I'm getting an answer to that question, I'm going to pull up that Dow list. Okay, now a lot of times people think, well, I got to come up with some special list. Who says that? Okay. Now, what I'm going to do is on the left-hand side, I'm going to bring up that Dow list on the left-hand side. And there was actually one of the stocks that has been quite strong. It's been yours truly, Big Blue. Now, Big Blue is kind of your classic example of the gap down. And then what you're now going to notice is it's kind of filling in the gap. Oh my gosh, pull my hair out. Okay. How many times have we seen this? Okay. Now, if we take a look at this, it kind of went up through resistance. The moving averages were Christmas tree green. And we had a little 2-day pullback. 1, 2, and then doink to the upside. Okay. Now, I'm going to kind of show this example. This is kind of classic of where the investor says, I don't want to actually maybe really have a higher likelihood of maybe being assigned to buy the shares at the strike price. Let's say the investor says, look, I think it could go up. Now, by the way, think about this. I was thinking about doing something, but I'll hold back. I want you to think about how many stocks in your lifetime have you seen that you could have said, I could have sold those pets or a put vertical and made a little portion of that trend. Is anyone thinking like, I feel like I've kind of maybe left some opportunity on the table? Okay. Now, I think a lot of people are probably in that camp. The thing is, we want to kind of get to that application sooner than later and really identify, is there a strategy that the investor might consider? Now, let's say the investor said, look, I'd like to get long the shares of stock, but I want to try to get the income. Now, let's do this. We're actually going to pull up the IBM. Let's pull it up. Go to the trade tab, type in IBM. Let's show kind of that compare and contrast here. The first trade we actually did was really kind of having a greater chance to be assigned. Now, that language is confusing. Assign on a sold put, assignment equals buying the shares at the strike price. That's what it means, okay? Now, if we went to, let's say, IBM, let's say 22 days expiration, does the investor have to do 22 days? No. They could actually go to the weekly options. They could go to the monthly options. Matter of fact, we'll pull these weeklies up, and we'll just double check and kind of see what's their open interest. Nothing that great, okay? Where we are seeing a little bit more action is really in, if I look at these, I don't see anything here on the weeklies that really looks that great, okay? So we'll close those up and really say, no, thank you. And then when we come down here to, let's say, the November 21st, okay, 2,400 contracts, 534 of which today, 25-cent bid-ask spread as of right now. Let's say the investor says, look, I'm going to sell, let's say, the 270 potentially. Let me get a couple more strikes. If we actually looked at this and said, where else do we see? Well, could we even go a lower delta? I'm going to show that. So let's say the investor said, James, I want to have about an 80% chance of being right. 23% chance of the stock being below the strike price. Hence, 77% chance as of right now the stock could be above the strike price. Now, I'm going to, why they kind of joked with me about listening to me 2 times the speed. So I'm going to go slow. Wiley, now you have me all self-conscious, okay? Okay, here we go. Now, what I'm going to do, okay, here we go. I'm going to click, let's do an example where even the bid, okay, we're going to click on the bid. And now if we click on that bid price, that premium is about $590. Remember, if you sell the 255, and we just did that by itself, it's going to want to set aside $25,000 because the risk is all the way down to 0. Many investors say, I don't want to tie that $25,000 up. Let's just kind of do this. We're going to sell the 255, and then we're going to buy a put below that. We don't ever think that that put below could be worth something. And by the way, if it is worth something, it tells us that the stock has gone down or the implied volatility has gone up. Now, what I'm going to do is to try to find something that might be a little bit more liquid. We're going to pick the 250 220s. So if you look at the 250 220s, why'd you choose that? Well, it's just a tighter bid-ask spread. You start going here, 60 cents. That one is possible, so you could do the 210, okay? If we wanted to widen that out, what does that do? A little bit higher credit, a little bit bigger credit, lower break even. But when you widen that out, it's also going to make the max loss bigger and the buying power a little bit bigger as well, okay? Now, any questions there? Now, I want you to think about this real quick. Have you left any potential opportunity on the table of stocks that were going up and maybe not really been comfortable with cash secured puts, short put verticals, and so on? Is this maybe a strategy that you've overlooked? Now, you got to think about something. A short put vertical, a cash secured put, is a potential stock buying strategy, but it also has an income component as well. Okay? Now, what I'm now going to do is note the extra commission because we're buying the put below. And then what we're going to go ahead and do is send the order. Okay? Now, so let's go back to this and kind of look and see what trades. So number one, we did BAC. We had shares of the stock, and then we entered into a covered call. That's a question that many people ask, especially right now. Fine. We showed that. Second, we actually did the example of the ExxonMobil position, okay? And that third example, if we actually went back and took a look at this, you're going to notice, I think we're missing one. Yeah, IBM, okay? So it just hasn't filled. Hence, it's not there. It's in working. It's right there. Yeah, now comment was IV on Exxon is low. Okay, now let's go back and kind of see, is that normal? Just briefly. Now, 2 ways we could see it, okay? So if we went back and looked at, let's say, the trade tab, ExxonMobil, when I look at, let's say, the options are about 40 days to expiration, take a look at this, and it's about 25. That implied volatility, which is annualized, it's going to tell me something about the option premium percentage, okay? I call it option yield. Option yield, really the option premium divided by what you bought the stock for. And so if that's 15 to 24, it's probably not going to be that high. Fair. Now, the other thing is we went down to today's option statistics, the IV low over the last year to kind of give us a range. This is like low temperature, high temperature, and where we are now in that range of temperature. But not temperature, we're looking at implied volatility. Well, we're in the 11th percentile. It's not the 11th percentile from the top, we're the 11th percentile at the bottom. So when you actually have something that has current IV percentile that's lower like that, the premiums are going to be lower. And that's why making sure that you run the numbers to see, is it something, a big enough option yield to consider doing it? I had a person tell me one time, I don't run the math when I sell puts. And I said, you got to be very careful with that, because that's telling you something about where you are in that range. And also, if you're, collecting some income, you're holding the other side of that stick, which is you potentially buying the shares of the stock at the strike price. So you actually do want to run the numbers and say, is this an adequate amount of premium for you to be on the line, or the hook, so to say, to be the buyer of the shares? So if someone doesn't run the numbers, it's kind of telling me you don't really understand what you're doing. If someone, a professional, runs the numbers, okay, someone that has experience runs the numbers. Someone that doesn't run the numbers, probably early on in the journey, I'm really laying that down, because if you don't run the numbers, it's concerning, okay? Now, I'll show another example. Let's kind of go back to this just real quick. I want to go back to, let's say you said, James, I want to learn maybe a strategy like this, but I kind of want to pick maybe a lower dollar stock price. Now, if you don't mind, I'm just going to kind of take a little quick sheet of paper here. And I'll admit, okay, I love, like, whether it's like note-taking apps or maybe Excel, whatever, okay? And so I like to use them just because it's just a simple way to kind of do the repeatable process over and over. This is the stock price, okay? So all I'm going to do in this case is we're going to take, this is the stock price, and then if we're talking about the example given of Intel, why am I choosing Intel? Well, it's a $33 stock. Whenever you're learning something, you might say, look, I want to kind of go to where the stock price is lower. That way I can practice something and it's not $300, okay? Now, the premiums aren't going to be as big, but the idea, the strategy, and so on, same thing. Now, what I'm going to do here is I'm going to go look at the 17 Octobers, and I'm going to go look at the first strikes out of the money. And a matter of fact, I'll even go Intel. And if we looked at, let's say, the first one out of the money, this is kind of surprising, actually. If I look at the first one out of the money, second one, I should say, that one, it really is the 3250 strike. So what do I mean by running the numbers? Well, all we're really doing is just saying, what's the strike? Well, if we sold the 3250, okay, and that option premium is, let's say, $1.55. Option premium. We're going to do this on the spot. So now all of a sudden what we see in this case is we got the stock price, the strike, the option premium, and now we just get to break even. Break even, of course, is just going to be 3250 less, okay, that 155. And so now what we get in this case is the break even, okay, is 30. That's not right. I went minus, plus, excuse me. There it is. 3095, okay? So when we look at the numbers, what do you mean by the numbers? All I'm going to do is just take the option premium, okay, divided by the stock price, okay? So all I'm going to do is just say, look, give the $1.55 divided by the stock price. This number, for many of investors that have experience, for many, they're saying 1% is like the low, okay? Now, you might say, well, wonder if you're going to do a one-day option. That's not what we're talking about, okay? When we talk about these options, we're typically talking about a minimum threshold of 20 days to expiration, okay? Now, this number, now, for our examples, 1.5% would be min, okay? 2.5% would be medium, and 3.5% would really be, let's say, high, okay? If you're getting something, 4.64, the number is telling you something. This little stock is volatile. We go back to the implied volatility, and it's 63%. Well, if we ran the number, we would know that, okay, without even looking at that. Now, if I pull it up and say, what's the other thing we want to actually look at? So this is the first thing. I could call this, by the way, option yield. When you kind of think about, let's say, a stock, a dividend yield, you take the stock dividend divided by the current stock price, okay? Now, here I just call it option yield. Same idea, though. Now, the other thing we want to kind of look at is kind of the, when people talk about I'm buying the stock at a discount, like I always kind of what I mean by that is how much of a discount do we buy it from where it is now? Okay, and if I do that, the discount is this is the discount from where it is now. It's 246. That's from where it is right now. But we want to put that on a percentage basis. And if you look at that on a percentage basis, it's about 7.3%. So let's wrap this up. When someone looks at these numbers, and I'll kind of circle that, it's just the discount. So when I say discount, it's the break even less the stock premium. Many people want to see at least a 4 to 5% discount. 5 to 6 would be medium. Anything probably above, let's say 7% or higher, it's a decent discount from where it is right now. That does not mean it's perfect for all investors, but that's what we really mean by running the numbers, okay? Now, what I'm going to do is I'm just going to click on this, and we're going to hold this there because I got to wrap it up, and we're going to click on 158, and we'll go confirm and send, okay? So today we did 4 examples. Got to see if that IBM one filled. 4th example was Intel, okay? What I want you to do is I want you to go out and practice these income-based strategies, a covered call, a cash-secured put. I think it's an interesting time to practice those in the Paper Money account. Now, I'm out of my time here today. I want to thank Rachel for answering those questions in chat, and thanks to all of you as well. Don't forget to subscribe to the Trader Talks channel right on YouTube. It's free. Just smash the thumbs up button, by the way. That way other investors could actually see this on YouTube as well. Stay tuned for our next webcast coming up right at the top of the hour. And this has been the class on Trading the Trend with a focus on covered calls and cash secured puts. Thanks so much. Take care. Bye-bye.